Hi, and welcome to dreamhomebykeith.com. You'll have access to the same program that I have, and you'll be able to put in your own simulation to make sure that this system works for you. Again, this is dreamhomebykeith.com. I'm going to go over an example of a client that I had, and we're going to use that as the reference for this. So all you need to do is go down, and I'm going to go over this whole program with you and go over everything you need to do to get this, and you can run this simulation for yourself. What this is a 30-year mortgage with a home equity line of credit as well as a checking account. The reason the checking account is so important is because in average, every 5 years, you are putting money in your checking account equals the amount that you owe on your mortgage. Your current bank pays zero or little interest on this, and it's not being applied to anything. What this does is this automatically, any money that's in the account automatically sweeps to the principal. You still have access to that money. You can write a check to every penny that's in your account at any given time. The checking account is no different. The only difference is it's now working for you because your current bank is using that money to invest and make money somewhere else. With this account, it's being invested in you by paying down your principal easier, but you still have access to it. So let's get started on this program, and I'm going to go through everything. We're going to start a new simulation. You click go. We're going to do this as a purchase. You can do it as a rate and term refinance or cash out, but this client was a purchase. You can do a primary residence, second home, or an investment property. For an investment property, you can go up to $1 million. For a primary residence, you can go as little as $100,000 all the way up to $3 million, same great rate. So we're going to do this as a primary, and we're going to compare this to a traditional mortgage. The purchase price he had for his home was $625,000. The loan amount he had was $500,000, which is 20%. We're going to compare this to a 30-year fixed rate. And we're going to do this. And if you want to compare what you currently have, if you have a mortgage currently, you change this from purchase to rate and term or cash out. And then if you've had it for 3 years, you put in 36 month shares. But as of July 9th, rates are between 7 and 7.25%. We're going to use a 6% rate, which hasn't been around for a while. But we want to show how this compares to everything out there. We're not going to compare any extra payments at this point, so we're going to just skip that. But this is where it gets really interesting. This gentleman put in $52.50 every other week, so he got paid bi-monthly. You have the ability of putting in a deposit. If you had $25,000, $30,000, $50,000 in a checking or savings account, making little to no interest on that account, this can be applied to principal. At the same point, and I emphasize, this is liquid money. You have access to this money at any time. But we're not going to do that in this case. So it comes out to where this gentleman is basically putting $11,000 into his checking account each month. His mortgage is $29.97. His taxes and insurance seem a little cheap, so we're going to make that $1,500. That leaves this gentleman $6,800 a month. We went over his expenses, and that includes his cars, the food, the miscellaneous, all his expenses each month add up to about $4,000. This left him roughly $2,800 a month. So we're going to leave that at $2,800. And this is where it gets really interesting. This is going to now pay off that mortgage in 11 years and 4 months. That saves you, compared to a 30-year fixed mortgage, at $275,000. And that's money in your pocket, not the bank's pocket. This means when you close, you sign what's called a truth in lending. And at the truth in lending, it's going to show you you're going to pay $1,079,000 for a $500,000 loan. But it gets better. And I'm going to answer a question you may have right up front. What about the $2,800 if I put it in the 30-year fixed? Wouldn't that pay it off quicker? Yes, it would, but this still beats it. And the other thing that's very important that most people don't take into consideration is there's a lot of programs out there where they say, do this, do this, do this, where you pay all this extra money, but you don't have access to this money. This gives you access to this money and it still pays it off quicker. But let's go to this situation. Let's say you've lived in this house now 5 years and you need to sell it. How much have you applied to your principal at this point? After 5 years or 60 months, you've paid $34,700 towards your principal. If you need to get a payoff, your payoff is going to be basically $465,000 on the mortgage. With this program, you would have paid down $157,000, almost 5 times more money than a traditional loan. The payoff on this would be $34,700. This program is so unique, and if you think this is something that's important, would you please like and share this? Share this to your financial advisor. I'll be happy to go over this program with them. But there's something else here. Right here is a unique number. And what you can do, and I'm including my email here, you can email me this and I'll be happy to go over this. Or if you'd like, you can do a mortgage consult. I'll actually do a Zoom call with you and we'll go over this program and make sure that this works out for you. This is one of the best programs out there. You can absolutely pay off your mortgage a lot quicker. If you live paycheck to paycheck, this does not work for you. This is not the right program. But if you are a saver and you put money aside and you constantly put money aside, this is probably the best program out there. I don't know anything, and I've watched all the other programs where you can pay off your mortgage quick. This is the easiest without changing your lifestyle and making your life so much better. And the easiest thing you can do is accumulate more wealth by paying off your mortgage. It's the biggest expense that we all have.